Welcome everyone to Vested Interest. This is Shane back for a Stock Pick of the Day video. It is July 10th, Wednesday. We're going to take a look at one in my portfolio today. I have been reviewing a few in my portfolio lately. I like to do a back check on what I'm holding just to make sure it still meets some of the criteria I set up. So we're going to take a look at Kraft Heinz. This is out of the consumer staples sector here. And before we get into the video, if you could do me a favor, hit that thumbs up button down below if you find any value in the content. Make sure you are subscribed to the channel. Very, very close to 1,000 subscribers. I think we were right at 998 subscribers before this video. So hit that subscribe button. Help me get to 1,000. We can do it on this video. Really appreciate everyone out there who's done that. Really love to see the channel growing. It really does encourage me to let me know that you're all out there finding some value in the content, which is very nice to see. And again, really appreciate everyone out there. Make sure you hit that notification bell so you're notified whenever we put out any new content. I do these videos Monday through Thursday whenever the market's open. I also do subscriber suggestions. So if you have a company like this, like Kraft Heinz, you'd like me to cover in the Stock Pick of the Day series, go ahead and drop it in the comment section down below. And again, make sure you hit that subscribe button and make sure the notification bell is rung so you can tune back in whenever we drop that video. Now, this is the vested interest stock screener. This is my way of looking at, out of the thousands of stocks out there on a high level, I can take a look at a company and see if I am interested in doing more of a deep dive into the financials. If it doesn't meet this screener, I just pass and go on down the road. So this is a high level screener. It is not a decision making tool for whether or not I'm going to buy a stock. There's a lot more that goes into it. This gives me an idea if it meets the screener, 5 of 8, or if it's a financial company like a bank, an insurance company. Then it goes onto my watch list and I do more of a deep dive into the financials, into the balance sheet, into the income statement. I'm looking at stuff like debt to equity ratios, assets over liabilities. I want them to have more assets over liabilities. I want decreasing debt over time. I want to see their revenues growing over time. I'm looking at margins. Are their margins expanding or are they declining? I like to look at price to book. I like to look at PEG ratios, price to sales. There's a lot of other information that you should be looking at whenever you're looking at a company beyond this screener. Again, this is just an initial screener to look at the thousands of companies out there, plug this in and see if I'm interested in even adding them to my watch list. You can use this, you can change this. This doesn't work for some growth stocks. You know, if it doesn't pay a dividend, stuff like the dividend payout ratio wouldn't matter, growing dividend wouldn't matter. Check valuation based on dividend yield theory. None of those would matter on a company that doesn't pay dividends. So you can tweak this. Maybe if you're not a dividend growth investor, maybe you have some other stuff that you'd like to look at. Revenue you could add in here. You could look at margins initially. You can tweak this. Don't blindly copy mine or anyone else's screener. You use it and set it up how your investing strategy is set up. Let's jump back into the video here. We are looking at Kraft Heinz today, and you can check them out at their homepage, www.kraftheinzcompany.com. That's www.kraftheinzcompany.com. That is their homepage where I pulled this information from. And as you can see, a lot of brands that you're going to know, Kraft and Heinz being the two that makes up the Kraft Heinz name. You know, this was a merger at one point. These were two separate. But then you've got mac and cheese. You've got Ore-Ida, Oscar Mayer hot dogs, Classico, which is like a sauce, Italian sauce. I think they have several types of sauces, cheese sauces, Velveeta cheese, Smart Ones, Jello. Who doesn't know Jello? Kool-Aid, Waddies, Capri Suns, Philadelphia, the cream cheese, Lunchables. You know, all the different brands. Maxwell House, for those of you who out there might drink Maxwell House coffee, Grey Poupon. All the brands under their umbrella, and I'm sure some of them are in your cupboards. Kraft Heinz is probably most notable for their ketchups and their mustards and other condiments that they make. Now, the reason we're taking a look at them, down 0.03% on the day, so not a big drop, but a drop nonetheless, and I did want to review them because they are in my portfolio. It is one that I've been watching for a while now because they have not increased their dividend for a while now, but we'll get more into that later. We are talking about the Kraft Heinz Company, ticker KHC, out of the consumer staples sector. 52-week range as low as $30.68, as high as $38.96. So they are right up against their 52-week low here. Market cap of 38.76 billion, a beta of 0.52, so they are less volatile than the overall market, even though today there was quite a bit of volatility. PE ratio $13.94, so low PE on this one. I believe their forward PE is even lower than that. Earnings per share, EPS sitting at $2.29 per share. Earnings date coming up July 31st, so at the end of the month. For dividend, $1.60 paid out in the year. They are a quarterly payer, so divide by 4, though we'll see what they pay out per share here in a little bit. Dividend yield, very high dividend yield on this one, 5.01%. Ex-dividend date of June 6th. They paid out on the 28th. So I got my dividends. Kudos to those of you out there who did as well. 1-year target estimate, they're saying $36.18, at least according to Yahoo Finance. So they do see some upside as far as price appreciation in the stock price. Now let's jump over to some statistics, and we're going to look at dividend yield theory. To do that, we take a look at their 5-year dividend yield average, and we compare it to their current, or over here where it says forward. I know it says forward, but it's just the current number. That's why it matches up. 501%. So since their current dividend yield is higher than their 5-year average of 4.68, that speaks to some potential undervaluation, at least according to dividend yield theory. Now their payout ratio, I like 75% or lower. They're sitting at 69.87%. So they are on the high side for payout ratio, but they are a pretty well-established company. So that just means that of their free cash flow, 69% of their free cash flow is going to paying dividends. The rest of it is going to stuff like buying back shares, paying down debt, making acquisitions, reinvesting back into the company. So with them being a little more built out, well-established company, international company at that, they are choosing to pay a little bit more on their dividends. And this may be why they have not raised their dividend in a while. They may be waiting for this payout ratio to come down so that they can start increasing again. It's under the 75% that I look for, but it is getting up there on the high side. Now let's take a look at free cash flow. I like growing free cash flow over time because typically if a company has growing free cash flow and they're a dividend paying company, they have growing dividends to match. This one does not. And it also doesn't have a long history of growing free cash flow. So again, maybe the reason why they are not growing their dividends. But if you go back to 2021 here, you can see $4.4 billion in free cash flow. 2022, $1.5 billion, so a big drop off from 2021 to 2022. Now they did start growing again in 2023, back up to $2.9 billion, and the trailing 12 months. Now remember, trailing 12 months. Remember, it includes part of 2023 and whatever we're in so far reported in 2024. So that's what it means by the trailing 12 months, TTM. That's what that stands for. It's sitting at 3.2. So it doesn't look like they're going to have a good year. It looks like they're going to continue that growth trend for 3 years, but they do not get a check because back in 2021 to 2022, they had a big drop off. Now they are repurchasing their own shares. Looks like they've got a little bit more aggressive over the last couple of years, but you can see here 2021, 271 million, 2022, 280. Pretty big jump up there in 2023 for 155 million, and then so far looks like they're continuing that trend into 2024. Though again, remember, part of this 762 could be accounted for out of this 455. So we'll have to see what exactly they end up with at the end of 2024 here. But they wouldn't get a check for growing free cash flow on that one. We're going to jump over to stockanalysis.com where I pulled this information from. And now stockanalysis.com and Yahoo Finance are just two sources that I go to for information. I am not affiliated with either, and you should be looking at more than one source for information as well. Don't blindly look at one source and take their information as gospel. Sometimes they're incorrect. Sometimes they're not up to date. So I recommend 2, if not 3 sources for information. Now they have 12 analysts that have taken a look at this. They call it a consensus buy. Now, if you were to go to stockanalysis.com, you'd be able to click onto each one of these little tabs, and you'd be able to see how many called it a strong sell, none did, none called it a sell. I think a few called it a hold, most called it a buy, and some called it a strong buy. You'd be able to click on those and see how many of the 12 called it each one of those. Now, they do have a low estimate of $34. It currently sits 6.52% lower than their lowest estimate. They have an average estimate of $38.92. That's pretty much in line with what we saw with Yahoo Finance on the previous slide, and that would be a 21.93% increase in the stock price. And they have a high estimate of $43, which would be a 34.71% increase in the stock price. All the while, you would be able to collect that 5% dividend yield, at least if you were to buy them now. Now, we're going to jump into statistics here, see how well this company is reinvesting back into itself. I like to look at return on equity and return on invested capital. That's what ROE is, return on equity, and return on invested capital, ROIC. I like 10% or better. Now, they're not meeting those metrics quite here. Return on equity, 5.7%. Return on invested capital, 5.15%. So I don't like that. That's a little lower than I like. Now, EPS growth, I typically like 5% projected over the next 5 years or better. They're sitting at 10.68%. Really like that with revenue growth forecast at 2.05%. Now let's jump over here and look again. This is one in my portfolio, so I thought I'd snip this out. I do have 190.965 shares of Kraft Heinz. I am down significantly, 12.68%. I have not been adding to this one recently. I may start looking to add to it over the next couple of weeks just to bring down my cost basis while it's right up against its 52-week low. I wouldn't mind getting over 200 shares on this one, though with it not raising its dividend, it is one on the potential chopping block over the next year or two if it doesn't start raising the dividend again. So I'm hesitant to add, but then again, I should be adding because if it meets the metrics, it meets the metrics. We'll see where it sits at the end of this. But anyways, down 12.68%. I do have 6,900 into the position. It's worth $6,000. I've lost about $881. Well, I haven't lost anything because I haven't sold anything, but I'd be down 800. Now I am running covered calls on this one to kind of decrease that amount I'm down. So you can see here that's what this is. I'll go over that more in my portfolio update on Sunday. So another reason to hit that subscribe button and hit that notification bell so you can tune back into our portfolio updates that we do every Sunday morning, where I cover everything in my portfolio, every stock I own, any sales I've made, all my buys for the week, any dividends, any options I'm in. So tune back in for that one. Now looking at it again, quarterly payout ratio in the 69%, 69.87%. No dividend growth. They have been stagnant in the dividend for a while now. Buyback yield of 0.97%, shareholder yield of 0.598%. Very good numbers. When you're looking at buyback yield, you want a positive buyback yield because that means the company is at least getting good value when they're buying back their shares. Now, they do pay out on March, June, September, December timeframe. They were paying 40 cents, going all the way back to 2021, I think even before that. So we won't really go through it. Still paying 40 cents. I do want them to start growing their dividend again. I think they may be waiting a little bit to get their payout ratio a little lower before they start it, but I would like to see some dividend growth, even if it was slow dividend growth, 1%, 2%, something like that. But anyways, let's wrap this one up. Here's the stock screener, right? We started with understanding the business. Check there, growing free cash flow. It was not. We had the down year between 2021 and 2022. The growing dividend, nope. No check there. It's been stagnant for a while. Now, it does have a payout ratio of under 75%, so check there. Dividend yield theory does say it's potentially undervalued. Check there. It is below my cost basis and right up against its 52-week low, so check there. Now, return on invested capital and return on equity is not 10% or better, so no check there, but the earnings per share growth is over 5%. It was actually over 10%, so a check there. So 1, 2, 3, 4, 5. It is in my portfolio. It will remain there. I may add a little bit, may nibble on this one, at least try to get it over to 200 shares, especially while it's right up against its 52-week low. And just for giggles, I did go over and look at this price to book. Its price to book is under 1 right now. Its PEG ratio is under 1 as well. So it does, according to some other metrics that I look at, it does appear to be undervalued, at least, like I said, according to some of the metrics that I like to look at. Well, that is it for this one. Let me know what you think of Kraft Heinz down in the comment section below. It is a slow grower. I know that. And the dividend growth is non-existent right now. I know that as well, but it may be undervalued. I may look to add to it a little bit, even though I hate to say that because it's growing. It's not growing its dividend, and I always talk about potentially replacing it. But I did do some comparisons to it and General Mills today, and some of the numbers do lean towards Kraft Heinz. I hate to say it, but it did. But as always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. So drop any of your suggestions down below or any questions you might have. Love to hear from you. And this is Shane signing off. Wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Hope you have a great week, and we'll see you in the next one. I'm not a financial advisor. Nothing in the presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk. You can't lose money and should never invest any amount you're not comfortable losing. Always do your own research. Invest based on your situation and circumstances and select criteria or seek the advice and counsel of a certified financial advisor.